Good evening. Good evening. So excited to have you all. This is our third online community connects. We do one once a month. So thank you guys for joining us. Feel free to share the link with any of your friends or family that can join us. We're going to get started now. Again, I'm Sadija A. Smiley. I'm the founder and CEO of SAILS, Stillborn and Infant Loss Support. We are based here in Laurel, Maryland, and we provide support and resources to families that have experienced the loss of their baby before their first birthday. So that covers losses from conception, pregnancy loss, tubal pregnancies, abortion, as well through the first year, which could include SIDS and any other loss that may occur to a baby before their first birthday. And some of the resources and services that we provide keepsake boxes to families that have experienced a loss that comes with mementos and ways for them to honor their baby. We also donate one cuddle cot a year to local hospitals here in the Maryland area. And the cuddle cot is essentially giving families the gift of time. The cuddle cot preserves the body of the baby so that it slows down the changes so that you can spend more time with your baby before saying your final goodbye. And then another service that we provide is financial assistance for burial and cremation. We hope to ease the financial burden of burying a child or saying goodbye to them in a way that's meaningful for families. No one wants to think about or be concerned with finances. How are they going to pay to send their child off in the way that means something to them? And so we offer financial assistance to help cover those costs. I have an amazing team. I don't do this alone. We have a board of directors. We also have some part-time staff and interns and volunteers that kind of help further the mission. And so I want to introduce them, allow them to introduce themselves. We'll introduce our presenter and we'll get started. If you have questions as we go, please go ahead, feel free, drop them in the chat. I will also put some links in the chat in case you guys have some other interests, ways to purchase our calendar. I'll talk about that at the end. And if you're interested in volunteering with us and becoming involved, I'll also put that link as well. So I'm going to turn it over to Angela, who is our board president, and allow her to introduce herself.
Hi, everyone. I'm Angela. I'm Angela Mendelson, and I've been with SAILS since the beginning and just recently took over as president of the board. So just trying to keep us moving forward and seeing all the things we're doing it's really exciting. So welcome and excited to hear what we're going to learn about today.
Awesome. Thank you. And I'm going to allow Crystal Allen to introduce herself. She is our board treasurer. And then Crystal will introduce our guests and we'll get started.
Sure. Welcome, everyone. I'm Crystal Allen. I have been with SAILS for about 1.5 years now. I'm happy to be a part of something so important, something that will help families ultimately, kind of deal with what happens in these situations. So I am an accountant. I've been in the business for about 20 years. I'm an entrepreneur. I have a catering business. I do so much. But I'm here to introduce Xavier. He has been in the finance game for more than 18 years. He is the founder and CEO of XNE Financial Advising, LLC. He has a book called Budget It Yourself. So, feel free to check that out. But let him get to it. He is the guy, the finance guy, Xavier Epps.
Oh, thank you so much, Crystal. And thank you all for having me. I extend my gratitude to the whole board and its invitees. And I hope this session, you all take away something concrete as it relates to budgeting. And I like small, intimate sessions because I can really hear what you're asking and actually answer them for free. So I don't have to charge you during the session, but I'm going to get through as much as my material as possible so we can get to the Q&A. And if you feel, fine with asking your questions out in the open, then go for it, because you never know what someone else may be going through and they may be having a similar issue, and I may answer 2 questions in one. So let's hop into it. I'm gonna share my screen. A little bit about me. I go by Finance Guy X. I'm a financial expert with over 18 years in the industry. I started out in Wall Street as a registered broker, and then I worked with nonprofits as a head of the finance shop for National Children's Center, National Wildlife Federation. I worked for local and the federal government. I worked at the United States Postal Service in a senior financial role, as well as the United States Postal Service Office of Inspector General. I currently am in a position with the DC government working for the mayor down here on Pennsylvania Avenue. I started XNE Financial Advising, LLC, after I left Wall Street in 2011. And I started because I wanted to do something different than wealth management. I saw a lot of people coming to me with questions about how to invest their money and what's the best strategic way to go about it, but they didn't have their taxes handled, their debt or credit in play where it should be, and they didn't have a clue how to budget a dollar. So it always made me very risque to say, take that money, invest it in XYZ stock, because that's all they had. So I started XNE Financial Advising in 2011 because I wanted to give people the fundamental analysis they needed to be successful in their goal to wealth accumulation. Since then, we've accumulated over 1,000 clients. We've managed more than 18,000 in revenue for businesses on an annual basis and more than 9 million for families. And we've processed more than 200 million in taxable incomes through the Internal Revenue Service. A little bit more about me. I'm a husband, I'm a father, and I'm an author. My daughter helped me develop my first book, Budget It Yourself, the front cover. And this came out in April of 2021, and it reached #1 on Amazon as a new release in personal finance. So hopefully you all can check that out when you get a second. So jumping into it, financial literacy. Yeah, I always say this is much bigger than just 1 + 1 or 2 + 2. Is really understanding how to read your money, how to read the numbers behind the scenes. I am what you call a fundamental analyst. When it comes to looking at numbers on a piece of paper, I also like to know how the numbers got to where they are and how can we make them better. So financial literacy is really big in that aspect, that it's not about what you're bringing in, it's about what do you know how to do with what you're bringing in to make it, grow bigger. So we'll talk about that a little bit. You should be examining and improving your financial knowledge every day possible. But it's unfortunate, and like I said, this is why I created my corporation. The basics of financial literacy or financial basics, period, aren't taught a lot in schools. Finance is typically treated with a trial and error mindset. We all do it. That's the way that we were taught growing up. If our parents weren't really big on how to manage money, as we became adolescent and we became young adults, we went through a trial and error mindset when it comes to finance. And it's unfortunate because the same people that didn't teach us are the same people that sometimes try to give us advice about how to manage money or manage investments or manage taxes. And these are the people that you probably don't want to take their advice from. So today, we're going to give you more knowledge so that you can depend on yourself. Budget It Yourself overview. Obviously, I'm going to throw in Budget It Yourself because the title of my book. It's bigger than just budgeting. And I break down 3 key fundamentals. One being understanding your taxes. It's crucial in America to understand not just tax strategies, but the legal loopholes. And when people hear the word loopholes, they may think, oh my God, that's something negative. They're there for a reason. And they're called a loophole for whatever reason people call them loopholes, but it's nothing you need to go to jail about. So understanding your taxes is big to me. I think the first 30 pages of the book, and it's a 75-page book. So the first 30 pages of the book is about taxes. And then the second chapter is about debts and credit. And the third chapter is about creating a budget. But in this presentation, I'm kind of give you that overview about the book and more details. So words and phrases you're going to hear a lot. You're going to hear me say credit. You're going to hear me say debt. You're going to hear me say savings. You're going to hear me say financial freedom because I have a trademark with the United States Patent and Trademark Office for Escape to Financial Freedom. So if you see anyone using Escape to Financial Freedom, let me know because I do have a trademark and I've had it for over 10 years now. Accountability is another word you're going to hear, a phrase, and taxation and budgeting. So let's talk about taxes a little bit. It's the tax season. April 18th is the tax deadline. And there's a lot of things that's out there that people get super confused with, but I try to make taxes simple as possible. So let's say if you're getting ready to file your taxes and you want to make sure that whatever you're about to do is in line with what you're doing, then you want to review your last year's tax returns. And I go in detail about that in the book. Some key things that I really don't understand why people overlook is the demographic information when someone else is doing your taxes. Making sure the name, addresses, filing status, social security numbers are correct. These are major because we live in an electronic world where if you submit something incorrect to the IRS, that will typically hold up you getting your return accepted or refund. So you got to make sure the key stuff, things that you know, like the back of your hand, is correct. When you're going through the process of doing your own taxes, you want to gather all your documents to confirm the actual amount of money you received. W-2s, 1099s, anything that you get, even if you are being paid as a 1099 independent contractor, and let's say that employer or company doesn't send you a 1099, you're still legally required to report that as cash on your taxes. And the reason being is this: a lot of business owners don't know what they're doing when it comes to taxes. And they don't know that they're, quote unquote, breaking the law when they don't file 1099s. So what happens is years and years and years go by and they get audited. So when they get audited, the IRS says, you paid $100,000 in 1099s to different people, but you never filed the 1099s. That's what they're going to rush to do. Now they're going to file 1099s. You, the person that received that didn't receive that 1099 and never reported income, gets this surprise out of the blue that, hey, there was income reported in your name that you didn't file. So now you have to go back, amend your taxes, and pay some type of penalties for underreporting income. So that's why it's imperative, if you're an entrepreneur or if you're someone getting some type of 1099 income, or you're working for someone that you're supposed to get a 1099 from, report every dollar, because you never know when that person is going to go and do the right thing and report what they paid you. Understanding your taxes. Our current tax system is based on a progressive scale. So what does that mean? Progressive means the more money you make, essentially the more taxes you pay. A tax refund, I tell this to all my clients, a tax refund means you gave too much money to the government, period. And what they're simply doing is saying, hey, we're giving you back the excess money you gave us. That's what a tax refund is. It's nothing magical, fairy dust, or anything that you're, being a good citizen, we want to give you money. No, it's because you pay too much. And because you paid too much throughout the year, we're going to give it back to you. Thank you for lending us the money, the IRS says. A tax bill means you didn't pay enough in taxes. And with that comes interest and penalties. So you don't have to worry about interest and penalties when you get a refund, but you definitely have to worry about that when you owe Uncle Sam. So some of the common penalties that a lot of people are not even familiar with are the failure to file penalties. This is a penalty that they charge you for filing your taxes not by the due date. And it's so easy to avoid this penalty because all you gotta do is get an extension. April 18th is coming. You're not going to make the deadline. Instead of get hit with a penalty for not filing, just request an extension for 6 months. Boom. And now you got to worry about it in October, and you don't have to worry about the penalty. Now, what that extension doesn't do is give you more time to pay taxes, hence failure to pay penalties. This penalty is charged the day after the due date or the extended due date happens. So let's say, in this case, you owe $1,000 and it's April 18th and you did file an extension. Well, just because you filed an extension to file doesn't mean you get an extension to pay. When you do finally pay it, guess what? They're going to retroactively go back to April 18th and say, we're charging you a penalty for every month that you didn't pay that balance owed. Estimated tax penalties. This is for our entrepreneurs, our sole proprietors, our business owners who generate revenue throughout the year from their business, their practice, and they don't pay into the taxes at all. So they're making, tens of thousands of dollars, but they're not paying anything into taxes. And the IRS will slap you with a penalty called estimated tax penalty, meaning you're not withholding enough taxes off your income throughout the year. And I've seen that more with entrepreneurs than I do with individuals with a 9-to-5, because if you got a 9-to-5, hopefully you're having your taxes withheld, hopefully. Imposition of accuracy related penalties or underpayment penalties. So this is you putting anything into the software, keying whatever numbers that you feel like keying into TurboTax or H&R Block software, and having no clue if you are supposed to have these credits and deductions you're taking. The IRS charges you a fee to have to fix your tax return. So that's the accuracy related penalty, because you're basically taking taxpayers' dollars, being IRS agents and staff and technicians, and tying them up by having to go over and fix your return so they can tell you how much you're going to get or not get. So they charge a penalty for that. And a lot of people don't know about that. Erroneous claim for refund or credit. Yes, if you claim a credit that you're not entitled to, you're going to be charged for that in terms of a fine. And typically it does it as a percentage of whatever the refund that you got that you weren't supposed to get is. And a lot of people that get caught with that are people that claim kids that aren't technically theirs, or they claim kids that they're taking care of, but don't have legal authority to get a credit, an earned income credit or additional or child tax credit. So those are the type of erroneous claims people make and they get hit with. A substantial understatement of income taxes. Again, if you are working and you forget to include one of your W-2s and it results in like a 50% difference of what you would have reported in income, you're going to be hit with a substantial understatement of income taxes. There are more than 28 penalties in the Internal Revenue Code as it relates to individual taxes. These are just a few of them. So how much in taxes should you pay? This is going to be based on a slew of different things. But at the end of the day, it comes down to your income on a tax bracket at various levels. And I try to not complicate this, but this is why I explain it a lot in detail in my book. If you ever seen the tax table, you will see, single, married, filing jointly, separately, hit a household, and widow. And under each of those titles, you'll see these ranges of income. You'll see 0% for this range, 10% for this range, 20% for this range, and then 25% or 30% for the 400,000 or above, right? So you see all these ranges. So one quite naturally will look at that tax bracket and say, I make 80 grand, right? I make 80 grand a year. Let me see where I fall out on that tax bracket. They'll go there, they'll multiply 80 grand by whatever they fall at in that tax bracket, and then they'll say, voila, that's my taxes for the year. That is so wrong. What you see on that tax table is thresholds. Each level of your income is taxed at a different rate. So if you ever look at your tax return, you'll see something called effective tax rate. And an effective tax rate is a summation of all your different incomes getting taxed at different levels. Case in point, if you make 80 grand, not all 80 grand is going to get taxed at 20%. The first 20 grand may be taxed at 10%. The next 20 to 40 grand is going to be taxed at 15%. And then 40 to 60 grand is going to be taxed at 20%. So it's different levels to how your income is taxed. And the reason why a lot of people ends up paying the incorrect amount is because they look at the table and they try to find their total income and match it up with one threshold and calculate the tax. So I told you that was complicated, but I tried to break it down for you. At the end of the day, if you've gotten your taxes done like a lot of us should every year, you have a pretty good idea of what your taxes are. At the beginning of the year, let's say you owed in 2020. And now that you know you owe, you find out how much you were supposed to pay. And then you take that number and divide it by 26 pay periods if you're a 9-to-5er that gets paid bi-weekly, or 24 pay periods if you get paid semi-monthly, or 12 months if you get paid monthly. Whatever you do, or however your income is earned, that's what you divide your total tax liability by, so that you know every pay how much to take out and put aside for taxes. So at the end of this year, 2022, you'll break even. The fix to owing less, breaking even, or reducing your refund size lies within the number of withholdings you have on your paycheck. And this is true for the states, not necessarily true for federal. So in 2018, we had an overhaul of the tax code. It went from tell us the number of exemptions you have to now tell me how many dependents you claim, multiply that by 2,000. And if you claim other dependents that don't qualify for the child tax credit, multiply that by 500. That is very complicated for a lot of people to be trying to figure that out. And what ends up happening is an art and science to finding out what the sweet spot is with your withholding. So if you go back to the previous example, if you found out now, hey, here's how much I should have coming out every paycheck, you can play around with that W-4 withholding calculator or form in your employer and say, look, I'm going to put 2,000 here, or I'm not going to put anything. And then I'm going to see what comes out of my next paycheck. If that matches up to the number that I calculated, what I need every month or every pay period, I'll keep it. If it doesn't, let me tweak it again. So you probably end up tweaking it 2 or 3 times until it gets to where you want to be as it relates to the number of the amount of taxes you want coming out from federal. The states, you can still do it based on exemptions. So tax deductions versus tax credits. This is big in the tax community because a lot of people don't understand what's the difference between a deduction and a credit. So a deduction helps reduce your taxable income, which generally means lower your tax bill. Credits provide a dollar for dollar cut in terms of your tax bill. For both, you want both. You want as many deductions and credits as you can get, right? But some of the popular deductions are retirement account contributions, like an IRA contribution, educational expenses, that's a deduction. Medical bills, it goes under your itemizations, your Schedule A. Property taxes, mortgage interest, those are deductions that lowers your taxable income. Charitable donations and classroom expenses if you're a teacher, up to $250 per teacher. Credits are opportunity, American Opportunity Lifetime Learning Credits. Those are educational credits. Child tax credit, the earned income tax credit, retirement savings contributions credits. Credits are things that reduce the tax liability. If you owe $5,000, these credits like $2,500 in American Opportunity will now take your $5,000 liability down to $2,500 because it reduces it. Whereas the deductions reduces your income. The deductions actually attack how much taxable income you have. I do want to talk about debts and credit. I'm going to skip to, we all know where to go at this point, Equifax, Experian, TransUnion, to find your credit reports. We all understand that the most 5 critical things of your credit score is payment history, credit utilization, length of credit history, new credit, and credit mix. Let's see, there's something. Oh, here's what I want to talk about. I want to talk about 2 methodologies as it relates to paying off debts. One is snowball method. A lot of people know about that. The other one is the debt avalanche method. So the biggest difference between the two, the debt snowball method is basically saying you pay the smallest debt first until you get to the largest. So you pay the minimum on everything, and then the extra that you have, you pay that to the smallest until the smallest is paid off. And now you have a little bit more to pay to the next smallest until they all gone. That's the debt snowball method. It's a very popular method to use when you want to have a quick impact on your credit score because it eliminates debt. Whereas the debt avalanche method is for people that have very high APR rates on certain debts. And this way, you still list your debts, but this time you use it based on APR. So you list APR highest to the lowest, and then you attack the debt that way. I always say exclude mortgages. Don't be sitting there trying to pay off a mortgage. You want to have a mortgage for the tax deduction, but exclude mortgages and exclude very expensive cars and possibly student loans. When I say, when you're looking at these 2 methodologies, really concentrate on consumer debt, such as credit card, retail, personal loan, line of credits, those type of debts. All right, and then let's talk about budgeting. Want to get to a good part. So here's a good part. This is an example of one of my clients' budgets that was done in 2020, 2 years ago. Template's pretty much the same. I'm showing you my thought process as to how I build a budget. I do it for 12 months and I do it in Microsoft Excel. So I can make it look really pretty. But I break down the core expenses first, and then I break down the monthly and debt expenses. And the reason why I break that down like that is because if you experience hardship, you want to be able to go to your budget and say, look, I'm not going to have XYZ money. What things can I immediately cut out? So you can see, hey, in terms of debts, who I need to call to negotiate some type of forbearance, who do I need to call about this financial hardship as it relates to the core expenses? What core expenses can I do away with that aren't really the necessity? So every client that I work with, I said they budget up like this so that we can track the difference between core and debt and monthly expenses, but as well as our savings goals, our plans year to date, and where we want to go. And all of this stuff is very customizable. So when you're building your own budget, do it in a format like Excel so that you can make changes to the budget, because this is just a budget. It's just a plan. It's not going to be what actually happens. Now we can have Q&A, and that's the book right there. This is how I can be reached on social media. Questions? I see some in the chat. Moderator, do you want to read them or you want me to go to it?
Yes, I am ready. So thank you first for that. And hopefully we were able to take some good notes, and we have some business owners on here. And so I know they have some really good questions. The first question is, would the date to file for business taxes be different from your personal or your individual taxes?
It depends on what type of business you have. If you're a sole proprietor, and when I say sole proprietor, in the IRS Act, you're still a sole proprietor even if you have an LLC. So they considered you a single member entity, LLC. So if you're a sole proprietor or you're a single member LLC, your taxes are due the same as your personal taxes, which is April 18th. Now, if you sat there and said, look, I want to change my classification, my entity classification, I don't want to be just a LLC or sole proprietor. I want to be let's say a nonprofit like you all's organization. Well, you all's nonprofits tax returns are due the 5th month after the closing of the calendar year. So if your calendar year is 12/31, then you all's taxes will be due by May 15th as a nonprofit, your 990s. But if you're a corporation, a C Corp, or S Corp, or partnership, C Corp, S Corp, partnership, guess what? Your stuff is already late. March 15th was the deadline for those 3 type of businesses. So it depends on which business you are, which is going to determine when your taxes are due.
Thank you. I have one question. Do you work virtually? Many of our attendees here are not in the state of Maryland. So if you're not in Maryland, do you work with clients virtually or do they need to be in person?
We have one client in every state. Our 1,000+ clients are scattered across the whole country. So everything we do are virtually. I built this whole corporation based on doing it electronically because I said, what's the use of having all that overhead and that operating expense when we can do everything virtually? So I've been doing it virtually for 11 years before COVID happened.
Mm-hmm. Another question, can you explain the changes to the child tax credit this past year with receiving payments before taxes were due?
So what happened was 2 things happened. The child tax credit got expanded in terms of how much. Normally you would get $2,000 per child, right? For the child tax credit. They expanded it to $3,000. They said, hey, we're going to do $3,000 per child. Essentially $3,000. I'm rounding things off. And the flip side, we're going to give you the option to have some of that advanced to you before, January 1st. So what they did was they allow people to either opt out and getting the advance on a monthly basis. So a lot of people were getting these advances. So imagine you having a child that you get a $3,000 credit for, right? And here we are about to be in April and you're filing your taxes and you're thinking you're about to get all this extra money. And then you put in that IRS notice saying that your one child, you got $1,500 because you got $300, for X amount of months, right? For those months. And now you see your refund immediately reduced by $1,500 because it was an advance. They just advanced that money to you. And what they're doing is doing the, you could consider it reconciliation, doing the tax preparation process. They're now saying, now you got to give it back to us out of your refund because we just advanced it to you. So you got some Americans that actually opted out. They say, look, I want to opt out. I want all my coins when I file my taxes next year. And they got the whole $3,000, but then you got some Americans that actually got the monthly advanced child tax payments. So when they filed their taxes, they saw their refunds be reduced by how much they received.
So
it was an advance.
To follow up on that, sorry, for the first time ever in my life, we did not opt out of the payments just because I wasn't on top of it to do that. And so is that possibly why I'm not done, so I want to go back and check it again and make sure I didn't mess something up. But is that possibly why we owe?
No, that's that. A lot of people are finding out that they're owing taxes because of that child tax law. So it could be very possible that that's the reason why you owe. Now and here's where keying in stuff in software could go astray unless you're a tax practitioner or a professional. I don't even know what your line of work is. But unless you're a tax practitioner, you may qualify to not have to pay it back if your income for you and your spouse or for you as a head of household recipient is lower than certain thresholds on that letter. So you should definitely look at the letter, because there's 3 different thresholds that they have there that says, hey, if you earn less than 75,000 and you're, I forgot what it said, single or head of household, then you don't have to pay back this credit. But you have to actually look at the language, because it's applicable to your situation. 9 times out of 10, if you're keying it into the software, you got to the end of the software and it says you owe, you probably owe. And it's probably driven because that advance that you received last year through July and December.
Yeah. And I was looking at the tax tables, and it seems like our income this year fell on a higher table than it normally does, and it's like on a lower percentage for next year. So like, why, I guess
Well, so your income,
our income didn't change. I know like what our incomes were, and then I looked at that like at a table online to see like where it would fall.
Sure, you're looking at something not totally correct. The tax table hasn't changed year to year. There's no inflation on a tax table. There's only inflation and COLAs on deductions and credits, right? Like the standard deduction gets a yearly cost of living adjustment. It's not the same 12,000 every year. It's 12,000 this year, 12,200 next year, 12,400, whatever, right? So the deductions are the type of things that get inflation or cost of living adjustments, not the actual tax rate, unless new law comes into play and say, hey, we're changing the tax code. So the last time the tax rate change was 2018 under the prior president administration. Before, so 19 and 20 and 21, all your tax rates are the same. Okay. It's a matter of you seeing, again, going back to that bracket, when you see that tax table, what you see ain't your tax rate, because your income is made up of probably 4 different layers, 4 different thresholds. There's a rate at the top that says 0% on the left side, right? And then it says income between 0 and 15,000 or something, right? And it says 0. So that means your tax rate is 0 for that piece of income. So if you make $50,000, the first 10 grand gets taxed at 0. And then the very next level says 10%, and then it says the threshold is anything between 15 to 30 grand. So your 15 to 30 grand gets taxed at 10%. Does that make sense?
Yeah.
So it keeps going until all your income has been taxed at the varying levels.
Okay.
But I guarantee you, if your income is about the same, if it's off by like 1,000, 2,000, but if it's about the same, your tax rate is effectively the same year over year. Okay. I'll look at it with you. You can send me your tax return. I can look at it for you. That's not a problem, free of charge, to show you that it's about the same. It's literally the same.
Okay, cool. Thank you.
No problem.
Another question. So you were talking about the letter, and we know that when you file, you have your AGI and you have your gross. So when they're taxing, and like for instance, you said 75,000 if you're head of household, is that your AGI, or is that before all the deductions and all adjustment?
That's your AGI. Anything the IRS gives you a break on is going to be, a lot of times it's going to be modified adjusted gross income. Sometimes they don't even do AGI because they know it can be manipulated by deductions, right? So they say modified adjusted gross income, MAGA. They say MAGI. But it's not your gross. So no, to answer your question, it's not your gross. It's not what you see technically on your W-2.
Okay. And then one last question, can you give us a couple of deductions or common deductions that business owners can use, or ways that they can kind of help offset costs? What are some of the common things for business owners?
One of the biggest things I want entrepreneurs or business owners to remember, and this depends on your entity classification. If you're an S Corp partnership, you can still take the deduction, but it takes some creativity on whoever is doing your taxes. But everybody else that's not an S Corp or C Corp, if you're a C Corp, disregard what I'm about to say. S Corp or partnerships, you can still do this. Everybody else, sole proprietors, LLCs, there is a deduction called QBI, Qualified Business Income Deduction. It takes off 20% from your profit in your business. So if you make 100 grand and you have 50,000 in expenses, now you got a 50,000 profit. Before it gets taxed, be sure you're using the QBI so that 50,000 isn't taxed. What really gets taxed becomes 40,000 because you get a 20% QBI deduction as a business, Qualified Business Income Deduction, QBI. That's one of the biggest deductions I see businesses not taking, and it's been there since 2018. I've seen people with $100,000 profit bring me their tax returns that's been done already and not take the $20,000 deduction, which is just automatic given the field that you're in, QBI deduction. So that's one of the biggest deductions. If you're profitable, it only works if you're profitable. If you're not profitable, it doesn't mean anything because the QBI deduction is for businesses that are profitable. So if you're a profitable business, you will get 20% off of that profit before it gets taxed on your federal income taxes. That's one of the biggest deductions I've seen in the last 2-3 years that people are just not looking out for when they do their taxes by themselves and they have a business. Your other typical stuff is your mileage. That's always big. Tracking your miles, making sure you have like a Mile IQ app. If you do a lot of driving, you have a Mile IQ app that tracks your business miles and your commuting miles. So when it comes time for taxes, then I say, hey, give me your mileage log. You're not sitting there making up numbers. Home office deduction. Home office deduction is a good deduction, but a lot of entrepreneurs or tax practitioners claim it incorrectly. A lot of people claim, like they say, hey, I got utilities. So they'll put utilities down on a tax return, not knowing that utility line on a tax return is if the business has a lease and actually pays utilities in the lease in the business's name. For a home office deduction, that's where you will put utilities at. And you will also put the cost of the rent if you don't have a mortgage and the insurance. And that deduction is multiplied by how much square footage you use in the property for your home office. So that's a deduction that a lot of deductions that I think about for businesses, it's not that people don't take them, they just do it wrong. And then them doing it wrong causes more of a headache and more, fines and penalties because they didn't do it right. So I'm always trying to explain how to take the deduction, not necessarily here's what to look for, if that makes sense.
Makes perfect sense. Great. A follow-up question to the QBI. Is there a minimum to earn the QBI? Do you have to make a minimum profit?
Nope. There's no minimum. And there's no maximum either. So if you make $300,000, $400,000 profit as a sole proprietor, you get, 20% off of that profit before it gets taxed. And it's a missed deduction. I see it so many times. And I had a client a week ago, $50,000 got taxed on it, didn't have the QBI. I charged them $200, but I also saved them $5,000 to do the amendment. So it's always, you got to weigh the outcome. Is it worth it? Does it make sense? And that's why it's great to capture these issues or mistakes before your taxes get sent off. One of the big things that we pride ourselves at XNE Financial Advising is that we have a preliminary tax review process. That means I do not send a tax return to the IRS until you've reviewed it electronically. And once you reviewed it and you give me the okay, that's when I e-file it. That's when it gets sent off. A lot of people don't do that. They get it and then they send it off and then you find an issue later on. So I pride ourselves that allows us to send without error almost 99% of the tax returns out the door without error. So take that chance to review it. Hopefully you get a chance to review it if you're going to a professional before it's sent off so that you can capture it now, because it's a headache trying to deal with correcting a tax return after it's already been e-filed.
Awesome. This was great. This was really good. We know this is a substantial cost. So we appreciate you dropping these gems for free because
free.
yes,
Yeah.
for the free. We love it. We love it. Thank you so much for your time, for your expertise. We appreciate it. As you all know, we are still selling our 2022-2023 awareness calendars. The funding, all the proceeds from that calendar go to support our Angel Ivy Burial and Cremation Fund, which is the financial assistance that we are able to provide to families to help offset the cost of their burial or cremation. Again, thanks, Chris. Thank you all for joining us. Joanna's hosting our next month topic. Can you give us a really quick sneak peek about what we can expect next month?
Yeah, so April 20th, during the week at 8 o'clock, we're going to be doing, I'm calling it a Lost Dads Roundtable. So my husband, Will, is going to be facilitating a conversation with 2 other bereaved dads, talking about their experiences with child loss and grieving and healing. And yeah, it should be really hopefully informative and engaging, and it'll be great to hear. We hear a lot of people asking about, wanting resources and support for dads who have lost children. So hopefully it will be helpful for that.
Awesome. Thank you, Joanne. Thank you all again for joining us tonight. Thank you, Xavier. Thank you, Chris. You guys enjoy your weekend and have a good time. We hope to see you next month.
All right. Thank you for having me.
Bye now. You guys take care.
Hey, everyone.